All right, let's work with the concepts from Chapter 19, which is looking at product costing in a job order cost environment. In a job order costing environment, we are manufacturing or providing services. This can apply to a service company as well, but we are manufacturing products that we can differentiate one from the other. So we will look at mass-produced products and how we cost them in the next chapter, but for now we're going to look at job order for inventory items that we can distinguish one inventory item from the next. So this first exercise is going to have us working with the concept of applying indirect cost, overhead cost, and then dealing with any under or overapplied overhead. At the beginning of this year, Mermax set its predetermined overhead rate for the movies produced during the year by using the following estimates. So prior to beginning this current year in the budgeting process, they estimated their total overhead cost, indirect cost of making the product of $1,680,000. They estimated direct labor cost of $480,000. And at the end of the year, their actual overhead costs were $1,607,000, and their actual direct labor costs for the year are $480,000. First, they're asking us to determine what is the predetermined overhead rate using estimated direct labor cost as their cost driver. When we are computing the overhead rate, we are dealing with estimates. Remember, the predetermined overhead rate is calculated before the accounting period begins. So our formula for the predetermined overhead rate is to take the total estimated overhead cost and divide by whatever it is that the company has identified as driving their cost. So they are using direct labor cost as detailed in the problem. Estimating overhead for the year of $1,680,000, dividing it by the estimated direct labor cost for the year of $480,000. $1,680,000 divided by $480,000, 350%. In other words, they are estimating that their overhead costs are going to be 350% of their direct labor cost for the year. Now that the company has that predetermined overhead rate, as they are accounting for the manufacturing throughout the year, they're going to use that 350% to apply an estimate of overhead into the inventory work in process account as they are accumulating manufacturing costs. So what they've asked us to do is set up a T account for factory overhead. They want us to enter the actual overhead cost incurred and the amount of overhead costs that would have been applied to their movies, their inventory items that they produced during the year using that predetermined overhead rate. Then they want us to determine, did they over or under apply their overhead for the year? So here's a T account for factory overhead. And remember, this is what I'd like to call a clearing account. This account is just helping us track and keep track of the amount of overhead that we apply in the work in process account and the amount of overhead that we actually incurred as we're incurring those costs throughout the year. As actual overhead costs that were $1,670,000, as those were incurred, we would have been debiting the factory overhead account for $1,670,000. As we were applying overhead based off of our actual direct labor cost, our actual direct labor costs during the year were $480,000. We would have been multiplying the amount of our direct labor cost by our predetermined overhead rate of 350%. That means throughout the year, we would have applied an estimate of our indirect cost, our overhead cost, into work in process of $1,680,000. So we would have debited work in process for this amount, and we would have credited the factory overhead account for that amount. That means that our actual overhead costs incurred during the year were less than the amount that we applied into the work in process account, we over applied. We applied more overhead than what we incurred during the year. We need to somehow figure out, what do we do? So as we recorded that overhead, that applied overhead, that estimate into work in process, we applied too much. So that over applied amount, we need to somehow account for it. And there's different ways we can kind of correct it. One of the ways, and the simplest way, is just to adjust our cost of goods sold. Because if we had applied too much overhead, it means our product costs recorded in work in process were too high, which means our cost of goods manufactured that we transferred into finished goods was too high, which means our cost of goods sold was too high when we sold the inventory. So to prepare the entry to close out that over applied overhead to cost of goods sold, we need to get rid of this credit balance. So to get rid of that credit over applied amount, we need to debit factory overhead. And then we are going to credit or decrease our cost of goods sold. So we have now closed out the over applied overhead and decreased our cost of goods sold for the over applied amount. Okay, that first problem that we just worked through was just helping us work with that one little part of the overall job costing in a job order costing system, just dealing with overhead. Now we're going to pull this together into a longer, kind of all-encompassing problem. Okay, so we're going to work with Watercraft's predetermined overhead rate is 200% of direct labor. So they have already determined in their budgeting process what is the amount of their predetermined overhead rate. So we don't have to do that. We did that in the previous problem, but we're not doing that here. They have given us our overhead application rate for the year. In addition to that, they gave us a whole bunch of information about production activities that occurred during the month of May. Okay, so we're going to come back to this. I'm going to jump down here and figure out what it is they want us to do. The first thing they're going to ask us to do is prepare a job cost sheet for each job worked on during the month. And we're going to use a very simplified form. And then we're going to go back and prepare journal entries for all of these events. Okay, so when we talk about job cost sheets, in a job order manufacturing environment, we are going to keep track of each job that is being worked on. We're going to keep track of their cost on this kind of side subsidiary ledger type sheet, right? So this is providing supporting information for what we are going to be recording into the accounting system. So going back up in here, I need to go in and figure out, okay, well, what products or what jobs are they working on? And it looks like during this month of May, they were working on 5 different jobs. 136, 137, 138, 139, and 140. So as they were working on these jobs in the factory, they were keeping track of costs incurred on a separate kind of side ledger, subsidiary ledger, separate document, tracking what costs they incur for each of these jobs as they're working on them. The 3 costs incurred to manufacture each of these: materials, labor, and overhead. So I'm going to go back and dig into some of this information, and I can see that materials that were used on job 136 through 40 are listed and detailed here. So I'm going to bring these material costs and put them into the job cost sheets. 48,000 for 136, 32,000 for 137, so on and so forth. Okay. Now, the next cost incurred to manufacture each of these jobs was labor. And I can see here that the time tickets have told us what direct labor costs were incurred to work on each of these jobs. So again, I'm going to bring these numbers over here onto my job cost sheets. So in the factory, as they were making and working on each of these jobs, the labor was recording their time spent on each of these jobs, right? So the job cost sheets are tracking each job's cost individually. The third cost that we needed to record onto each job cost sheet is their indirect cost. Now, as we are working on these jobs, we do not know what the actual overhead costs are, right? Because it could be later in the month of May, or it could be even later in this year before we know what are the actual cost of indirect cost incurred during the month of May, right? Because it might be delayed before we get our May utility cost until June, right? Or we may not have our factory insurance for May. We may not get that bill until July, right? But we can't wait until June, July, or August to get the indirect cost because we need to finish these jobs and get them sold to the customer now. So instead, what we do is we apply an estimate of that overhead using our predetermined overhead rate. And this company has decided that they are going to apply an estimate of overhead at 200% of direct labor cost incurred on each inventory item or each job. So if job 138 had labor costs of $12,000 multiplied by 200%, it means that the overhead that I am going to apply to that job is 12,000 times 200%, or 24 grand. Labor, 10,500 times 2, or 200%, is 21 grand. Job 138, 200%, or labor cost of 37.5 times 2 is 75,000. 139, 39,000 in labor cost times 2, or 200%, double it, is overhead is 78. Job 140, 3,000 in labor cost, we would have applied an estimate of 6,000 in indirect cost to it. So now I have a total cost accumulated for each of the jobs we've been working on. Okay. So recall that these costs have been tracked on a separate document outside of the accounting system. Our next job now is for the accounting department to take these job cost sheets along with some additional information that's provided and prepare journal entries to record all of these into the accounting system. All right, so let's go up here and look at our information. The first thing that they're providing us details about was the amount of purchased raw materials. All of these materials were bought on credit. Total cost of the materials purchased, $200,000. When we purchase raw materials on account, we are going to record those material costs into the raw materials account. So we are going to debit raw materials and credit accounts payable because they were bought on credit. The raw materials account is where we record all of the costs of materials that were purchased to be used in the manufacturing process. Those costs will stay there until we actually use those materials in production. And that's the information they provided in B. Material requisitions. Requisition is a term just meaning they were called into. These materials were requisitioned or called into use, into the production process. They have broken the amount of direct materials by job, but in the accounting system, we only care about the materials that were used directly in total. That means 128,000 of direct materials were pulled out of the raw materials and used in the manufacturing process. So in the general ledger, we need to record the fact that the materials that we originally recorded into the raw materials account are no longer part of raw materials, they are now part of work in process. So we are going to decrease the raw materials account. and record those material costs into the work in process inventory account. So we debit work in process to increase, credit raw materials to decrease. Okay. In addition to that, we also called into production indirect materials, 19,500. All materials, when we bought them, were put into raw materials. The indirect portion needs to come out of raw materials with a credit, and we record the cost of the indirect materials or the overhead cost directly into the factory overhead account with a debit. Factory overhead is debited for our actual overhead cost. Okay, so we took those costs out of raw materials and put them into the factory overhead account. Again, that is a clearing account, and we're just going to temporarily record those costs in there. Okay, the next item. Time tickets have recorded the following labor. Again, we have the total direct labor costs broken down by job. In the accounting system, we're only going to be recording the total labor cost. We also have some indirect labor costs of 24 grand. The total labor costs were 126,000. When we pay these labor costs, we're going to record the direct labor portion into the work in process account and credit cash. Okay. We do not want to record our payroll expenses as an expense yet, because we want the cost of payroll to be recorded as part of the product cost. Only when the product is sold do those labor costs become an expense as part of the cost of goods sold, as part of the product cost. So we're going to record the direct labor portion into work in process, and the indirect labor portion we debit into factory overhead. Remember, the factory overhead account is debited for actual indirect overhead cost. We debited factory overhead for our indirect materials. Now we are debiting it for our indirect labor cost. Okay, now that we have our direct and indirect materials, direct and indirect labor costs incurred, recorded into the accounting system, now we are going to apply overhead to jobs 136, 138, and 139. What happens when they finish manufacturing a product and they're getting ready to transfer the cost into finished goods? That is when they apply the estimate of indirect cost. So 136, 138, and 139, they're wrapping up all the work. We've already recorded their direct material and direct labor costs into work in process as part of our total recording of those costs. Now we are going to apply an estimate for 3 of the jobs. Remember, the overhead is applied at a rate of 200% of direct labor. So in order to know how much overhead to apply for these 3 jobs, I need to go back and look at what their overhead costs were. 12, 37.5, and 39. So if I add up those 3 costs and multiply those by 200%, 12,000 plus 37.5 plus 39,000, 88,500 was the total labor incurred on those jobs, times 200%. 177,000 is the amount of overhead that I want to apply. So I'm going to debit work in process for the applied overhead, and I credit the factory overhead for my estimate. Factory overhead is debited for actual indirect. It is credited for the estimate of overhead. Okay. All right, so then after we applied the overhead, we now transferred the costs of the jobs 36, 38, and 39 to finished goods inventory. This is where the job cost sheets come in very handy, because to look at the accounts in the accounting system, I would have to really dig in and go back and do some recalculations, because when I recorded costs associated with these jobs into the accounts, I was doing them in total. I only want to transfer costs associated with 136, 138, and 139 into finished goods. So if I add up those three costs from my job cost sheets and total them up, 84,000 plus 131,7 plus 139,4. Total costs that I need to transfer are 355,1. So I am going to credit work in process to transfer those costs out of there and debit finished goods, moving the cost from one inventory account into another. All right, we then sold two of those jobs, 136 and 138, sold them on credit for a total selling price of $525. Those costs of the jobs are sitting in finished goods inventory. We have now sold them. So going back to our financial accounting, when we sell inventory, we have two entries to record. We need to record the revenue earned. So we are going to debit accounts receivable and credit sales for the selling price. And then we need to transfer the cost of that inventory that was completed out of finished goods. How do we know how much to transfer out of finished goods? Well, that again is where the job cost sheets come in handy. Jobs 136 and 138 were sold. Total costs that have been recorded in the accounting system related to those two are 84,100 and 131,700, which means we need to transfer out 215,700 out of finished goods with a credit, and that is when all of those costs incurred become the expense cost of goods sold. So debit cost of goods sold, credit finished goods inventory. In H, we incurred some more actual overhead costs during the month. Depreciation on the factory, depreciation on the factory equipment and building, factory insurance that expired, which means we used up some prepaid insurance, accrued property taxes payable. We owe some property taxes. All right, so going back into our financial accounting memory banks, the account that we're going to debit is factory overhead, right? Because we are debiting actual overhead costs into factory overhead. So let me add these up, 68,000 plus 36,500 plus 10,000 plus 35,000, 149,500. So I debit my total indirect actual cost into factory overhead, and then the accounts I credit depend on what that indirect cost was. When we record depreciation, in the past we debited depreciation expense. Now we're recording those as part of the inventory cost, but we need to credit accumulated depreciation, which is our credit account. Expired factory insurance normally is a debit to prepaid insurance expense and a credit to prepaid insurance. And if we are recording a liability for our accrued property taxes payable, we credit property taxes payable. Okay. So again here, big picture, let's think about what we did. Instead of debiting depreciation expense, crediting accumulated depreciation, we debited that indirect product cost into factory overhead. Same thing with insurance. Instead of debiting insurance expense, credit prepaid insurance, we debit it into factory overhead. And then the same thing with property taxes payable. Instead of recording those indirect costs as an expense, we are keeping track of them within the inventory accounts because they are associated with inventory being produced. Okay. Okay, and finally, the last thing they're having us do here is apply overhead to the work in process inventory account for 2 jobs that were still being worked on, right? Out of the 5 jobs that we were manufacturing, we already transferred 3 of them out of work in process into finished goods. So they already had their overhead applied. But the other 2 jobs that are still in process, no applied overhead or no estimate of overhead has yet been recorded for them. So we are going to do that now. So if we're going to apply overhead, we need to know what the labor costs were for 137, which was 10,500, and 140, which was 3,000. So adding those 2 together, multiply it by our predetermined overhead rate of 200%. We are going to apply an estimate, debit work in process for 27 grand, and then we credit factory overhead for our estimate. Okay. All right, let's see what we want to do next. Okay. What they're asking us to do is set up T accounts for just some of the accounts, not everything that we were recording things into, just the raw materials, work in process, and finished goods inventory, the factory overhead, and the cost of goods sold accounts, and then post those entries into the T accounts. So down here I can see my general ledger, T accounts, raw materials, work in process, finished goods, factory overhead, cost of goods sold. And then I'm just going to go back one by one and post these in. Debit raw materials for 200. I'm not dealing with the accounts payable account, so debit work in process for 128, credit raw materials for 128. Credit raw materials, debit work in process. Debit factory overhead for 19.5, credit raw materials for 19.5. Credit raw materials, debit factory overhead. Debit work in process for 102. We're not worried about cash, so I'm going to debit work in process for 102. Debit factory overhead for 24. Debit work in process for 177. Credit factory overhead for 177. Debit work in process, credit factory overhead. Debit finished goods, credit work in process. Debit finished, oops, sorry, wrong account. Debit finished goods, credit work in process. Let's see, we're not dealing with those 2 accounts. Not dealing with cost of, oh, we are dealing with cost of goods sold. So debit cost of goods sold, credit finished goods inventory. Debit cost of goods sold, credit finished goods. Debit factory overhead, and we're not dealing with those accounts, so we're just debit factory overhead. Okay. And then debit work in process, credit factory overhead. Work in process, credit factory overhead. All right, so now what we're seeing in these T accounts is the effect of all of these things that we prepared journal entries for. Raw materials was increased for purchases, decreased for the materials that were used, leaving it with an ending balance of 52.5. Work in process was debited for materials, labor, and applied overhead. It was decreased when those inventory items were completed and transferred out to finished goods. Finished goods inventory was increased for the amount of the cost of goods manufactured, decreased for the cost of the inventory when it was sold, leaving it with an ending balance. Costs of all of the manufacturing that was expensed were only associated with the inventory that was sold. All right, so the last thing that they're asking us to do here is to, let me go back and shrink this down so we can read it. Compute the total cost of each job in process and prove that the sum of their cost equals the work in process inventory account. Okay, compute the total cost of each job finished but not sold, prove that their sum equals the finished goods inventory balance, and compute the total cost of each job sold and prove the sum of their cost equals cost of goods sold. Okay, so what they're asking us to do is prove that this agrees to the cost of the inventory that's still in process. Excuse me, the jobs that are still in process. This agrees with the cost of the inventory that is completed, ready to be sold, hasn't been sold. And that this balance agrees to the cost of the inventory or the jobs that were sold. So work in process. There's only 2 jobs that were still in process at the end of the period. Jobs 137 and 140. Looking at their job cost sheets, these detail all of the costs that were recorded into the accounting system for those 2 jobs. And if I add up those costs, lo and behold, they agree with the current balance in work in process. Finished goods. Of the 3 jobs that were finished, only 1 job has not yet been sold, job 139. If I look at job 139's job cost sheet, 139.4 was recorded into the accounting system for that job as part of our bigger entries, and that agrees with the balance in the finished goods inventory account. Cost of goods sold, we had 2 jobs that were sold, jobs 136 and 138, pulling their cost, 84 and 131.7. Add those together, total cost incurred on those 2 jobs, 215.7, and that agrees with the cost that we recorded for cost of goods sold. Okay, so big picture, this balance represents the cost of jobs that are still being worked on, not yet completed. This balance represents the cost of inventory that has been completed, not in process, but has not yet been sold. And this represents the cost incurred to produce the products that were sold and is now recorded as an expense and reported as part of our profit calculations. Okay. Now, the problem isn't having us do it, but let's really quickly go back and talk about this factory overhead account. Remember, as we were incurring actual overhead costs, we were debiting them into this account. And as we were applying overhead, we were crediting the amounts into this account. Because this account was left with a credit balance, I can conclude that the applied amounts exceeded our actual overhead. That means we are over applied here. We applied more in our estimates into work in process than we actually incurred. So if we were to go ahead and correct this, okay, we would, sorry about that, want to get rid of that balance. So my entry to clear out that balance would be to debit factory overhead for $11,000, and I'm going to adjust my cost of goods sold. I'm going to decrease it because I applied too much overhead during the year, which caused my product costing to be too high, which caused my cost of goods sold to be too high when I sold that inventory. So this is how I'm going to close out that balance and factory overhead at the end of the accounting period. All right, I hope this helps.